Hey traders, welcome back to another episode of the Trading Coach Podcast. Thank you as always for joining. Today, we're going to compare different time frames, talking about the differences between higher and lower time frames and how to use them together and maybe how not to use them together. So it should be a fun one. If you haven't done so already, I got a brand new YouTube channel. It's called Akil Shorts. If you like the little quick tip videos that I put out on social media, giving quick trading tips and hints, subscribe to that channel. Just YouTube search Akil Stokes Shorts and it'll pop right up. Ivis says, are you more prone to getting faked out if you're looking to enter on a lower time frame below the 30-minute? Yes, I wouldn't necessarily say below the 30-minute, but the lower time frame you go, the more noise is in the market. So everything is shorter term. So I don't know if that's, maybe not. I don't want to say fake out necessarily, just for word purposes, but there's a lot more. The lower time frame you go, the smaller the moves you have, the less valuable your signals are. So like a daily candle is more important than a 5-minute candle. Like a hold of structure on the daily chart is more important than a hold of structure on a 5-minute chart, because there's so much more noise that can happen. There's so much more wigglage that can happen on the lower time frames. So I don't want to say it's specifically below the 30, right? But just in comparison to higher time frames. So think about it, the higher you go, the more conviction there is in the signal, the more meaning the candle has. Right? Think about it like this. It's the, you guys ever heard the saying where it's like, or the tactic where like if you want to avoid making impulse buys, like say you're at the mall, right? If you guys don't know what a mall is, right? It's a physical brick and mortar building, right? Talking to the young people, it's a physical brick and mortar building where people used to travel to buy goods, right? No computers. There was a human exchange, person to person. What's a mall? Is that Amazon? But think about like avoiding impulse buys at the mall. What do they always say, right? Go home. Think about it. If you still want it just as bad tomorrow, it's probably a good buy. If you don't really want it tomorrow, then it was probably an impulse buy, right? It's probably, you see it. Oh, no, I want that. You don't really want it, right? So the charts are the same thing, right? The lower time frames are more like the impulse buys, right? Because on a 5-minute chart, all the decisions are made within 5 minutes. Most great decisions aren't made within 5 minutes. On a daily chart, the whole day is taken into account. The whole day is taken into account. So there's a lot more thought that goes into that decision, which makes it a lot more powerful. So with that being said, should you be afraid to trade the lower time frames because of the noise? What do you guys think? Should we avoid lower time frames? No, right? We don't need to avoid lower time frames. You just have to understand what they are. You just have to understand that, hey, if I'm trading the minute chart, there's going to be a lot more noise than me trading the daily chart. And that's not necessarily a bad thing, right? We talk about the range bar charts, right? I love the range bar charts. The range bar charts, if you guys are unfamiliar, they print on a specific range. So they don't necessarily print on a time duration. So it's not you don't get a candle every 5 minutes or 10 minutes. You get a candle every time price moves out of a specific range, like tick charts are the same. So if I have a range bar chart that is set to a 5 range, every time the market moves out of a range of 5, right, it's going to print a new bar. And sometimes we see slow action where you get like 1 bar every like 30 minutes. Sometimes you see a lot of action where you may get like 10 bars in 10 minutes. And that is considered noise, right? That is noise, but it can be beneficial to the trader because it's going to give us signals that we may not get on a 15-minute chart, right? If we get 10 candles in, 10 minutes on a range bar chart, and those 10 candles give us like a breakout, a pullback, a retest, a higher high, higher close, and a chance to get involved in the trade, that's not even a completed candle on the 15. So by the time it happens on the 15, the move may be over. So I don't want to make it seem like it's all negative. You just have to understand what it is, right? At the same time, on a lower time frame, right? CPI comes out, sorry, PPI, right? Gosh, all these acronyms, man, I hate them. CPI, PPI, ISM, right? PPI comes out in about 14 minutes, right? If this and this is a high impact news event, right? Let's say the market moves 20 pips. Oh man, right? You guys do it all the time. Akil, yen's moving. I'm looking at it. I'm like, no, it's not. Like, what are you talking about? Like, let's say the market moves 20 pips. 20 pips on a minute chart. That's a lot of movement, right? Would you guys agree? That's crazy. Crazy, right? A 20 pip spike on a minute chart, right? Chart's gone wild. When you look back at it on a daily chart, does it even have an impact? You don't even notice it. You can look at a daily chart and not even know anything came out, right? You got a 100 pip range on a daily chart. Those 20 pips aren't doing anything. It might be the little wick at the bottom of the candle. That's it. But on a minute chart, you may get whipsawed to death as it goes 20 pips against you, then 20 pips in your favor, and all that fun stuff. So it's more about knowing, understanding what you're getting on the time frame you're trading on. The one thing that I would warn you against, and we do this all the time, talking about consistency, right? And this is where the noise or the fake breaks can get people into trouble. The people that try to go from like the daily chart, they have an idea on the daily chart and they want to enter it on the 5-minute chart. Like, that is it. I want to slap people that do that. I apologize if any of you guys do it, but you deserve to be slapped. You deserve to be white gloved slapped, right? That's the official way to do it, right? I challenge you to a duel, sir, right? But you'll see people do that. You'll see people analyze a major level-ish structure on the daily chart, right? And then they go down to the 5-minute chart. And on the 5-minute chart, they got a lower low, lower close. And because of that lower low, lower close, that level of structure on the daily has been violated, and we're in bearish trend continuation mode, baby. Are we though? Are we? Maybe on that particular time frame we are. But people will do stuff where they'll set up a daily chart trade with like stops and targets off of the daily, but the entry is based off the 5-minute. And it's like, right? So that's where you can get into trouble. So I think when you're making jumps like that, those are too big of jumps, right? Daily to 5 hour. I think that when you're making jumps in trading time frames, as far as like higher time frame, trading time frame, lower time frame, they should probably be, aside from like, you know, when you get to like the really high ones, but especially going like 4 hour and below, they should probably be within like a 4x spacing. Not 4x, but like 4 times. So like 4 hour to hourly, or like hourly to 30, like hourly to 15, 15 to 5, like 3 to 2, 2, 3, 4x, something like that. I believe that's a good range, right? If your lower time frame is 50 times lower than your higher time frame, you're not really seeing the same thing. Now, with that being said, just to end it, I'm not saying that, you know, because I was a day trader and daily levels were useful to me. So I'm not saying you can't blend the two, but I'm specifically talking to probably the newer trader that doesn't really know what they're doing, right? Because I would take levels off the daily as importance, but I would also, right, because I would analyze it for my swing trading, but I would also see what's happening on the hourly, because the hourly was my higher time frame for my day trading. So there are ways to do it. I'm not saying, you know, daily levels aren't important or anything like that, but don't try to enter a daily trade based on a 5-minute. You can be aware of the daily level, but understand the 5-minute trade is a unique trade in its own right. So your stops and targets, all that fun stuff, should be based off that unique time frame and not off some 1,000 pip profit target mark that you're looking for on the daily. That's where you get yourself into trouble. So, good question. What pair were we looking at again? We actually did some good analysis before we did that. Gold, and we're continuing down here on gold. Hope you found today's podcast to be insightful. Again, the point is there's not a wrong or a right or a good or bad time frame or time frame combination. It's all about being consistent. And that's my job as a trading coach, to make sure you are consistent in your analysis, consistent in your execution, and that way you can be consistent in your profitability. All right, I'll see you guys next time. If you haven't done so already, make sure you subscribe or follow or share, whatever you need to do to support this podcast, wherever you listen to this podcast at. And of course, if you're listening on YouTube, do me a favor, give that thumbs up button a hit. All right, until next time, plan your trade, trade your plan. Take care.